The Chrysler Building at 405 Lexington Avenue in Midtown Manhattan, the most precisely beautiful skyscraper in the history of American architecture, by the consensus of every generation of critics, historians, and architects who have assessed it since its completion in 1930. The stainless steel eagle gargoyles, the sunburst crown, the Art Deco ornamentation, and the 67-floor tower that briefly held the title of tallest building in the world before the Empire State Building surpassed it 11 months later constitute an architectural achievement whose cultural authority has never been seriously challenged. The building is not merely beautiful. It is the building that established what American ambition looked like at the moment of its maximum self-confidence, completed in the year after the stock market crash that ended the era it celebrated. It has been financially underwater for most of the century since. The Chrysler Building's ownership history is, in the forensic framework of this channel, the most precisely documented case of a trophy asset whose cultural value has been consistently used to justify acquisition prices and debt structures that its operating cash flows have never been able to validate. The building generates rental income from its office tenants. It generates tourism revenue from visitors who photograph its crown from the street. It generates cultural authority that no other building in Manhattan commands with equivalent consistency. None of that has been sufficient, in any ownership cycle since Walter Chrysler built it, to produce the financial returns that the successive acquisition prices have required. The most recent iteration of the Chrysler Building's financial distress involves the Abu Dhabi Investment Council, which acquired a 90% ownership stake in the building in 2008 for approximately $800 million, and Tishman Speyer Properties, which retained a 10% stake as managing partner. The acquisition established a debt basis that required the building to generate net operating income at a level that the Midtown Manhattan office market of the subsequent decade did not consistently produce, and that the building's physical characteristics, its pre-war floor plates, its elevator bank configuration, and its mechanical systems, made difficult to optimize for the tenant requirements of the contemporary commercial real estate market. The forensic entry point for this case is the gap between what the Chrysler Building looks like from the street and what it produces on a balance sheet. Because that gap is the most precisely documented example in American real estate history of the proposition that cultural authority and financial viability are not the same variable. If this is your first case file from this channel, subscribe now, because every episode adds one more layer to what you are about to understand about the architecture of institutional failure. The Abu Dhabi Investment Council's 2008 acquisition of the Chrysler Building was structured through a transaction that valued the entire property at approximately $800 million, a figure that reflected the peak of the pre-financial crisis Midtown Manhattan office market and that established a debt service obligation requiring net operating income at a level the building had not consistently produced in the preceding ownership cycle. The acquisition closed in July 2008. 2 months before the Lehman Brothers bankruptcy that case file 0-1 documented, and that initiated the most severe commercial real estate market contraction since the early 1990s. The covenant structure governing the Chrysler Building's acquisition financing was written for a Midtown Manhattan office market that the 2008 financial crisis was in the process of dismantling. The specific vulnerability embedded in the covenant was the building's tenant concentration. The Chrysler Building's largest tenants were financial services firms whose own financial distress in the post-crisis period produced lease renegotiations, downsizing, and in several cases departures that compressed the building's rental income below the stabilized projections the acquisition financing had required. The covenant thresholds that specified minimum debt service coverage ratios became increasingly difficult to maintain as the tenant base contracted and the rental income that the ratios required declined. The Chrysler Building's pre-war physical characteristics compounded the leasing challenge in a specific way that the 2008 appraisal had not adequately priced. The building's floor plates are smaller and more irregular than those of the modern glass towers that have absorbed the majority of Midtown Manhattan's financial services tenant demand since the 1980s. The elevator banks that serve a 67-floor Art Deco tower designed for the office culture of 1930 do not meet the efficiency standards that contemporary large floor plate tenants require. The mechanical systems that have been updated through successive renovation cycles carry the cost and complexity of infrastructure grafted onto a structure whose original design predated the technology those systems now serve. Those physical characteristics are not deficiencies in the aesthetic sense. The building is as beautiful as it has ever been and will remain so indefinitely. They are deficiencies in the financial sense, because they make the building's leasable space less competitive for the tenant categories that command the rental rates necessary to service the debt that the building's cultural authority allows it to carry. At what point does a building's cultural authority become a financial liability rather than a financial asset? Leave your analysis in the comments below. The appraisal methodology applied to the Chrysler Building's 2008 acquisition shared the foundational error documented across this channel's 22 case files, but expressed it through the specific dynamics of the Midtown Manhattan office market in a way that makes the Chrysler case uniquely instructive for understanding the relationship between architectural prestige and financial performance. The stabilized net operating income projection that justified the $800 million acquisition price assumed rental rates per square foot consistent with the peak of the mid-2000s Midtown office market. Lease-up assumptions that treated the building's cultural authority as a competitive advantage capable of commanding premium rents from tenants who would pay above market rates for the prestige of a Chrysler Building address, and a capital expenditure schedule that treated the building's ongoing physical maintenance as a bounded cost rather than as a recurring structural obligation of a 94-year-old tower. All three assumptions proved inadequate. The rental rates that the mid-2000s peak had established as the baseline declined sharply as the financial crisis reduced demand from the financial services tenants who had been the building's primary customer base. The lease-up assumption that the Chrysler address commanded premium rents proved partially correct, but insufficient. The building did command a prestige premium over comparable pre-war office space, but the absolute rental rate that premium produced was not sufficient to service the debt size to the 2008 acquisition price, and the capital expenditure schedule consistently underestimated the cost of maintaining a building whose systems and structure require ongoing investment at a rate that the building's net operating income, even at peak performance, struggles to accommodate alongside debt service. The forensic parallel with the hotel cases in this channel's archive is precise. The Chrysler Building case replicates the Plaza Hotel pattern documented in Case File 002. An asset whose cultural authority consistently allows ownership to borrow against valuations that the operating business cannot service, producing successive cycles of acquisition at premium prices, financial distress, and transfer to new ownership at prices that reflect the distressed circumstances of the sale rather than the cultural value that justified the premium. The Plaza's appraisals treated landmark designation as an asset. The Chrysler's appraisals treated Art Deco perfection as an asset. Both treated the cultural value as a revenue-generating input rather than as a cost-generating liability. If the forensic analysis this channel conducts is changing how you read real estate headlines, the like button is how the algorithm knows to send this case file to the next analyst who needs it. The Abu Dhabi Investment Council's management of the Chrysler Building between 2008 and its eventual sale in 2019 documented a pattern of institutional behavior that this channel has not previously examined in the context of sovereign wealth ownership of trophy commercial real estate. The extended tolerance of financial underperformance by an ownership whose capital base and investment mandate insulated it from the market pressure that would have forced a conventional investor to sell or recapitalize the asset on a shorter timeline. Sovereign wealth fund ownership of a trophy asset that is generating insufficient cash flow to service its acquisition debt produces a specific form of institutional patience that is neither the denial documented in the Fontainebleau case nor the strategic management of loss distribution documented in the Caesars case. It is the patience of an institution whose primary objective is not the maximization of financial return from any individual asset, but the preservation of capital and the expression of sovereign ambition through ownership of globally recognized assets. The Abu Dhabi Investment Council's continued ownership of the Chrysler Building through the post-2008 market contraction, the slow recovery of the 2010s, and the disruption of the office market that the 2020 pandemic accelerated, reflected an institutional tolerance for financial underperformance that no private equity firm, REIT, or individual investor could have maintained without triggering the creditor interventions that the building's debt service shortfalls would have produced. That tolerance did not resolve the building's structural financial problem. It deferred it. When the Abu Dhabi Investment Council and Tishman Speyer sold the Chrysler Building in 2019 to a group led by Signa Holding and Offer Holding for approximately $150 million, the sale price represented an 81% decline from the $800 million acquisition price of 2008. One of the largest documented losses on a single trophy asset transaction in the history of New York commercial real estate. The building had not deteriorated. The crown still caught the light over Midtown at dusk with the same precision it had caught it in 1930. The financial structure around it had absorbed 11 years of operating shortfalls and sold at the price the market was willing to pay for the problem it represented. The Signa and Offer acquisition of the Chrysler Building in 2019 for approximately $150 million established a new debt basis for the asset at a level so far below the cultural value of the building that the new ownership's financial challenges would appear, in theory, to be solved by the acquisition price alone. A building acquired at $150 million requires a significantly lower net operating income to service its debt than a building acquired at $800 million. The arithmetic of the basis reduction should have produced the financial relief that 11 years of Abu Dhabi patience had failed to achieve. The Signa Holding Company filed for insolvency in Austria in November 2023, one of the largest real estate insolvencies in European history. Its American assets, including its interest in the Chrysler Building, became subject to the insolvency proceedings and the asset management complications that cross-border insolvency produces. The building that had survived the 2008 financial crisis, the slow recovery of the 2010s, the pandemic-induced office market disruption, and the Abu Dhabi ownership's 11-year tolerance of financial underperformance, was now entangled in a European insolvency proceeding whose resolution timeline bore no relationship to the building's own operating circumstances. What the Chrysler Building case reveals about the broader pattern of institutional failure documented across this channel's 22 case files is the specific proposition that a building's cultural authority is not a financial variable in the conventional sense. It is a borrowing capacity variable. It allows successive owners to borrow against valuations that the operations cannot service. It does not generate the operating cash flows that would make those borrowings serviceable. The gap between what the Chrysler Building looks like and what it produces is not a temporary condition that better management or favorable market cycles will close. It is a structural feature of the asset that every ownership cycle has discovered and that no ownership cycle has resolved. The eagles on the gargoyles still face Midtown. The sunburst crown still catches the light at dusk. The building is as beautiful as it has ever been. The debt structure around it is as unresolvable as it has always been. The marble does not lie. The balance sheet never has. If this case file changed how you evaluate the relationship between architectural prestige and financial performance in trophy commercial real estate, subscribe to this channel, because the next case examines a building whose financial structure was designed specifically to prevent the outcome that the Chrysler Building has experienced repeatedly, and whether that design succeeded. And in the comments, given the Chrysler Building's documented history of acquisition prices consistently exceeding its operating income capacity across multiple ownership cycles, what specific underwriting standard would have produced a sustainable capital structure for this asset? The case file is open.